In the last couple of years, the markets have been very focused on macro events, political events, and we think that as the world starts to improve, that those issues that we faced the last couple of years will start to wane in its level of importance. If you take a fresh look at your portfolios today, and you have to ask yourself, do you have the right diversified mix of assets to benefit from an improving global economy where the macro won't be such a dominant force as it was in the last couple of years? The issue that you face with fixed income instruments such as core bonds today is that they yield an incredibly low amount, say 2% on a 10-year US Treasury bond, and you have two risks associated with that. One is that it doesn't keep up with the rate of inflation going forward. So if you expect inflation to be 2% in that scenario, then you're going to earn on a real basis nothing. If inflation picks up beyond 2%, you're going to start to earn negative returns. The other risk that is associated with owning an instrument just like core bonds is that rates start to rise. So if rates on government bonds move from 2% upwards, you can take a loss on the principal that you have invested in that bond. It's very easy for investors to say they want to have a certain allocation to a risk asset, and because they're fearful of markets today, decide to hold less than what they know they need to hold. For those clients that say, and take an example, they should own 40% equities based upon return expectations and risk tolerance. If they sit there and they own 20% equities, that particular investor is not right risked based upon return expectations and risk tolerance. I think that equities are a good first step if you own too much cash or corporate bonds, because you need to start buying an asset class that doesn't have the same type of correlation as that. Certainly, we believe that they're going to provide the types of returns in a growing global economy that we'd like to see. We do think that global economic growth should average somewhere along the lines of 3.5% in terms of GDP. In addition to that, equities also provide inflation protection, which is also important to keep in mind. As there's a lot of liquidity in the system today, at some point in time in the future, inflation may start to pick up more than it has been in the past. Equities usually are a beneficiary of a rising inflationary type of environment. I frequently get the question, why should I buy equities today? Because they're sitting at all-time highs. And the fascinating thing about that is that equities have hit all-time highs for decades upon decades upon decades. If you take a look at equities today versus their last peak in 2007, earnings are 20% higher here in the US than they were back then. So you're getting at a discount, arguably, relative to 2007 peaks, 20%. So we think equities are cheaper than they were back in 2007. And we do think that the prospect for growing earnings will be better. So even if valuations don't change, equity markets can continue to move higher just by virtue of the fact that companies are growing their earnings. If you look at the valuation of equities today, they're below long-term averages, and they happen to be particularly cheap relative to fixed income instruments. So from a valuation perspective, equities are still cheap despite the run-up.